Hello everybody, Jackson here from the Wealth Squad today, talking to you about growth stocks. So we're going to be looking at finviz.com and looking for some growth stocks here today. So I've already put in some requirements, right, where we have 26 options that we're going to look through, or skim through, I'd say. And you can see we already have some criteria chosen. So I'm going to be explaining that right now, right? Quick ratio, short-term liquidity, right? Over 1 is good. Under 1 means that they're hurrying for cash, right? They're cash short. So over 1, of course, is a healthy company. The higher the better. And less than 1 means that they're struggling. They need more cash. EPS growth next 5 years, that's pretty explainable. Return on equity, on the other hand, measures the company's profitability and how much profit a company can generate with the money invested through shareholders. This is on finviz.com, and just like I've been doing already, in order to see what something means, just hover over it and I'll tell you. But this is for growth stocks, right? We did dividend stocks earlier in a different video, and that was completely different criteria. But you can see a lot of this stuff is just EPS growth or sales growth. You can see it's all over 15%. But the quick ratio, that just measures, if they're cash healthy. Return on equity measures, effectiveness or efficiency within the company. While the PEG or PEG ratio, basically a value of 1 means the company is trading fair. Over 1 is where it gets kind of dicey. Under 1 is undervalued. But I have it under 2 just because the amount of stocks that are within that under 1 range is kind of slim. And we want to look through many options today. And that's just because, the market has been going up a long time now. And, it could go up more than this, and we don't want to miss out just by waiting for the right opportunity, right? So we are going to, lower our standards a bit here just to find more options. Then, of course, the country USA. That way we just feel safer as an investor, as a shareholder in that company, knowing that we get all the right information. And, the company's not dealing with outside policies or stuff like that. So let's look at the valuations of these companies. So you can see I'm ranking them by market cap. Of course, Amazon, Netflix, AMD, Applied Materials, Cisco, Deckers, all companies we know, Yeti, the one that makes those cups, Sage Therapeutics. So, I'd say the first 6 or 8 we know, or at least you should know. But the forward PE ratio, or the PE ratio, is not a good indicator of a growth stock, right? You want to look at earnings growth and the PEG ratio. So you can see the PEG. We're just going to rank it by lowest to highest here. Sage at a 0.10. Some other stuff that is really small. You can see the market cap in the millions, under 100 million. So it's best to stay with the companies. Let's actually add one. It's best to stay with companies over, let's just do at least 2 billion. Just because that gives us another safety net where we can't get scammed as shareholders. So yeah, Sage, IPB, Applied Materials. All right, so this is a PEG ratio. Of course, most of the options are over 1, and that's all right. We're just gonna have to sell for that. But you can see all this earnings growth here. Financial. Let's check out how these companies are doing financially. You can see the ROA, ROE, and ROI. If it's in the green, that means they're doing pretty good. Quick ratio, the more cash they have, the better. That's what that means, quick ratio. Over 1 is healthy. 1 is right where they need to be. And under 1 is danger zone. You could also see a whole bunch of these companies don't have too much debt. The ones that do have debt, we should probably avoid. Halo and Cisco, looks like. Check out some ownership of these companies. Insider owned, institution owned. And check out the performance. See how these companies are doing. What we want is a company on a discount, right? We want a company trading at a discount. If we buy at all-time highs, then our risk is certainly a lot higher than if we buy it near the all-time lows. If the company is safe, right? If the company is bad, in bad health, then we shouldn't buy it at all. But if the company is still trading at a fair valuation, and it's been getting slammed recently, and it's a good business, then we should definitely buy it. So I guess let's go back here. Let's rank by market cap and check out performance once again. So we can see RPM trading at a heavy discount. Sorry, not heavy, but compared to the market, it's pretty heavy. Yeti as well. A lot of this stuff is just very, very high. Sage, huge discount from 80s now at the 46 range. Technical. I meant to press this. Charts. Let's check out these charts. Let's see what's trading at a discount. So, Amazon still trading at a discount from 37 now at 34. Netflix is not. AMD somewhat 120 to 110. Applied Materials. This is actually posted on the Will Squad Instagram as a stock to watch, just because it's in this, it's in this wedge. If you buy it here, you could potentially sell it when it climbs and goes up, right? That's what happens when it's in that trading range. Cisco discounts, Decker discounts. You know what? This doesn't look too bad. Knowing what we know from our technical standpoint, PEG's over 1, but slightly. Forward P at 17, P at 23. The price to book is kind of high, but you could see all of this growth is kind of compensating for that. No debt, some long-term debt, no short-term debt, healthy cash position. So yeah, just from the screener, I'd automatically look into AMAT, Applied Materials, knowing what we know from a technical standpoint as well as financially and fundamentally. It does look like a pretty good deal. So, that's what this video is meant to show, just how to find growth deals using finviz.com. And I hope that helped. Just kind of a quick video summarizing what to use, what to look for, and how to look for, mentally. Maybe the best deal isn't the best. There's some underlying aspect that makes you want to avoid it, right? Like with Netflix, if Netflix had these great numbers, I'd still be cautious because Netflix is now not the number one, streamer. Maybe they are number one, but 5 years ago, they had no competitors. Now they have 10, right? The market is heating up. I would not want to be in one of those streaming stocks, especially not the biggest one. But that's just my take. Do your own research. This is just showing how you could find growth stocks using FinViz. And I hope this helped. And if it did, like the video and subscribe to the channel, and I'll see you later.